Welcome to Wealthfinity. In today's video, we're going to dive into the world of inflation and help you understand what makes a good annual inflation rate. We'll explore the pros and cons of different inflation rates and help you determine which one is best for your economy. Whether you're a seasoned investor or just starting out, this video is a must-watch for anyone looking to increase their financial literacy. So sit back, relax, and let's get started. Annual inflation rate is a measure of the increase in prices of goods and services over a one-year period. It is used by governments, central banks, and economists to gauge the health of an economy. A good annual inflation rate is one that is low and stable. Inflation is a measure of the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Central banks, economists, and investors closely monitor inflation rates as it has a direct impact on the economy and personal wealth. A low inflation rate is generally considered to be around 2% or lower. This is because a low inflation rate means that prices are not rising too quickly, which can lead to economic stability. When prices are rising too quickly, it can lead to uncertainty and volatility in the economy, making it more difficult for businesses and consumers to plan for the future. A good inflation rate is generally considered to be around 2% per year. This moderate rate of inflation allows for growth in the economy while also maintaining the purchasing power of consumers. Inflation rates above 2% can signal an overheating economy and potentially lead to higher interest rates, which can slow down economic growth. On the other hand, inflation rates below 2% can indicate a stagnant or weak economy and may lead to deflation, which is a sustained decrease in the general price level of goods and services. Moderate inflation, typically defined as an inflation rate of 2 to 3%, is also seen as positive for an economy. This level of inflation can signal a healthy level of economic growth and can also act as a buffer against deflation. Deflation, or a sustained decrease in the general price level, can be harmful to an economy as it can lead to decreased spending and investment. A stable inflation rate is also important. When the inflation rate is unstable, it can lead to a lack of confidence in the economy. Businesses and consumers may be hesitant to invest or spend money because they do not know what to expect in terms of prices in the future. A stable inflation rate helps to provide a sense of predictability and security in the economy. However, high inflation can be detrimental to an economy. High inflation can lead to uncertainty and can make it difficult for consumers and businesses to plan for the future. High inflation can also lead to a decrease in purchasing power, which can lead to decreased spending and investment. High inflation can also lead to higher interest rates, which can further slow down economic growth. As an investor, it is important to monitor inflation rates and understand how they may affect your investment portfolio. By keeping an eye on inflation, you can make informed decisions about where to invest your money and how to protect your wealth. It's worth noting that inflation affects different segments of the population differently. Low-income households and fixed-income retirees may be disproportionately affected by rising prices, as their incomes are not likely to rise as quickly as inflation. Therefore, a good inflation rate should also take into account its impact on the most vulnerable segments of the population. The Federal Reserve and the central banks of other countries target a specific inflation rate, usually 2% annually. They use various monetary policy tools such as raising interest rates to keep inflation in check. It's important to note that while a low and stable inflation rate is generally considered to be a good thing, it is not always the case. Sometimes a low inflation rate can be a sign of weak economic growth or even a recession. In such cases, a moderate inflation rate may be preferable as it can signal a healthy and growing economy. A good annual inflation rate is one that is low and stable. This helps to promote economic stability and predictability, making it easier for businesses and consumers to plan for the future. It's important to remember that inflation rate is one of the many indicators of the economy's health and should be considered in the context of other economic indicators such as GDP and unemployment rate. In conclusion, the mystery of a good annual inflation rate is a complex and multifaceted topic that is influenced by a variety of economic and societal factors. A moderate rate of inflation, typically around 2%, is often considered to be optimal for promoting economic growth and stability. However, it is important to note that inflation can have negative effects on certain groups, such as retirees and those on fixed incomes. Ultimately, the ideal inflation rate will vary depending on the specific circumstances of a country and its economy. It is a topic that requires ongoing monitoring and analysis in order to make informed policy decisions.